Let me switch focus. The big question now is, have markets already priced in the worst with regard to geopolitical shocks, or is there more volatility ahead? With geopolitics driving sentiment, questions around India's valuations, FI flows, and energy risks are back in focus. We decode all of that and more in this edition of The Interview. With, of course, none other than Sunil Singhania. Ayesha Faridi had that conversation with Sunil. Listen in to a slice of it.
I think I'm very sure that every investor knows that markets will go through cycles. And I'm very sure that no one likes not to make returns or make losses. So it's not a pleasant scenario, even if you are a long-term investor, to see a portfolio in the red, even for the near term. However, if you take a 3-year view, 5-year view, even now we have seen very decent returns. I think the problem has been the last 1.5 years. And even that till February was pretty decent. It's only in the last 1 month, because of this conflict, we have lost a little bit of returns which we made. But in the past, we have seen, whether it was during Russia, Ukraine, whether it was during COVID, whether it was during the tariff issue, which was at the peak last March, April. I think markets tend to bounce back pretty fast and pretty well. Because these are events, which ultimately will have to get settled. So no one can doubt that this conflict also will de-escalate. Now, it's a question of whether it happens today or tomorrow, or whether it happens in the next couple of months. There's no doubt that it will happen. As I said, from an India perspective, we are to that extent relatively immune, being a domestic economy. I think the challenge has been not only the price, but availability of raw materials, availability of energy, and supply chain issues, rather than only the conflict. And if those things get settled, then the probability of India's profit growth coming back to 15-18% is there, and then everything gets sorted. So, we are pretty optimistic that over a period of time, even global investors will again start to look at India. And Aisha, we look only at the secondary market flows. Over the last 6-8 months, there have been such huge deals in the banking side, in NBFCs, in the private equity domain, where billions of dollars have been pumped into the country by really strategic and long-term investors. You see RBL Bank, Shriram Finance, some other companies, Federal Bank, you have the Bhujia brand, and so many others, where strategically large investments have come in. So it's not that global investors are bearish on India. Yes, it's a portfolio call as far as the listed space is concerned. But, they will come back because, as I said earlier, the weightage of India is now at a 10-year low in most of the global investors' portfolio.
But Sunil, to the more niggling worry, and that seems to be oil right now, and the sensitivity to what's happening in West Asia, each $10 rise in crude prices can widen India's current account deficit by roughly about $15 billion annually, and also stoke inflation, which was so under control up until a month back. Tell me, how should investors think about FI27 earnings estimates right now? And is it time to then brace for meaningful downgrades, which fortunately haven't come up until now, or you think the market is already pricing in the worst?
So obviously, high oil prices are not great news. We import 85% of our energy needs. But, I think 2-3 things. One is for having that dramatic negative or pessimistic view, we will have to be of the opinion that this conflict is going to continue and oil will continuously be at $115-$120 for the rest of the year. I don't think that is what we believe in. In fact, on the other side, I would say that, if you look at silver prices, it took 2 months for them to move from $50 to $70, another month to move up from 70 to 120, and then within 2 months, it was back from 120 and 70. And no one was predicting silver prices to fall the way they have fallen. I think oil has followed a similar trajectory, 2 months from 60 to 70, a month from 70 to 120. At least, my view is that it's a matter of time before this 120 falls to 70 and 80. Because on a demand-supply basis, oil in normal times is in an oversupply kind of a situation. In fact, now if you see, Venezuela started producing oil. US has allowed Russian oil to be sold. Even Iran oil, India bought Iran oil for the first time in 7 years. If there is some settlement, I'm very sure that Iran will also start to pump oil. And on the other hand, every government, irrespective of the country, will start to work on the alternatives, whether it is nuclear power, renewables, and so on and so forth. So structurally, the demand-supply scenario points out to a weak oil. Now, this war premium of $25-30 is built in. Hopefully, conflict should end. It's not only about money. Ultimately, so many lives are being lost. And definitely there will be some solution. It's a matter of time. So our base case is not of oil continuing at these levels. But yes, in the near term also with oil at $110, $20. And more importantly, what I mentioned earlier, the supply chain is an issue. There are some sectors, some companies which had to reduce production or even shut down production. So there is definitely going to be some impact on the earnings trajectory. I think on 1 month basis, we are already seeing 1.5-2% cut in FI27 numbers, but we'll have to take it as it comes because we don't know when and in what form this conflict will de-escalate.
Sunil, which sectors do you think are going to see the sharpest earnings pain? And are there any actually benefits from this environment as well?
See, very hypothetical question, if you just take a 1 month view, then obviously, if inflation were to go up, as you rightly mentioned, that if oil prices started to get passed on, there will be inflation. Already yields have moved up to 7.05, 7.1%. So obviously interest rate sensitives like banks, infra, real estate will all suffer. But on the other hand, if there is some resolution, these would be again the high beta sectors which will benefit the most. I think there will be some defensives. In this case, IT, which was out and out, is now acting as a defensive because their earnings will not be impacted. In fact, with rupee being where it is, there might be 1-2% positive, I would say tailwind for them, including pharma. Some of the longer term benefits, so to say, is sectors which will benefit out of rebuilding of the Middle East. Some sectors which will benefit because countries will want to move away from relying only on Strait of Hormuz. So maybe, infrastructure, pipeline, and so on and so forth. I would say the big push on renewable will again be very intense. And therefore, incrementally, renewables, particularly solar-oriented sectors are something which we believe should do well in India. But again, this is very hypothetical, let us see how this conflict and as I said, what time frame and in what form it unfolds before we take a very sure shot bets on sectors.
Cyril, correct me if I'm wrong. You recently exited 2 small cap positions, one healthcare bet and a water management firm. What triggered? Is there concern in investor circles right now? And is the big chatter? And what it signals, or does it signal a broader rethink on small caps all by itself?
I think portfolio structuring is a day-to-day activity for us. So there are reasons why we exit stock. One is if the valuations become significantly higher than what our comfort is, and it's always great to make profits. Second is if things are not working out the way we anticipated. So it's always better to accept that things are not working out the way you expected, and you need to exit. And third is if you get something better than what we already have in the portfolio, because ultimately capital is finite. So this is a regular exercise. It does not denote anything. I think we keep on evaluating, we keep on looking at it. Only thing I would say that we are not big churners. Our churn ratio is normally at 10-15% a year. So the average holding period for us is at least 5 years plus. Therefore, I don't think there is too much to read. The other thing is many times a lot of these data also is not reported properly. You have 1% in a company and maybe, you sold a little bit, or your corpus goes up and it goes out of your top 10, 20 holdings. And there are so many data compilers who keep on compiling data in whatever they want. So I don't think you should read too much in the data which you're referring to.
So in your meets framework, Sunil, the 15-15-15 matrix, does this market now qualify as attractive, or are earnings downgrades still the overhang risk?
No, it's not very easy to be a value-focused investor. Frankly, last 18 months have been tough. Now there are companies which are coming up there and which look interesting from a 2-3 years perspective. India is a great economy and a market that way. You have so many listed companies, so many sectors. Something does well, something does not do well. So you always have those opportunities if you are on the right side of it. But I think we are looking at this also optimistically. We have seen that outsized returns have always been made when investors have invested in adversities rather than good times. So you would have made more money investing when the Russia-Ukraine war broke out or when COVID broke out than in mid 24 when everything was looking spick and span. So I think this is an opportunity, and that is how at least my 25, 30 years of investing experience has taught me. We are up there trying to meet companies, trying to speak to them, trying to be as connected to them, because ultimately we believe that companies who are resilient in terms of their earnings are the ones which will bounce back the fastest.